Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Dhruv Nagarath, Director of Fixed Income Strategy at BlackRock. And we are talking about attractive opportunities in the bonds ETF space now because the Fed has started its easing cycle. And we know when interest rates fall, bond prices go up. And in fact, we have seen some revived investor interest in bonds and bond ETFs lately. So it's a good time to talk about bonds. So welcome back, Dhruv. Thanks for joining us today.
Thanks, Neena. It's great to be here.
So now we have had several weeks of strong economic data since the Fed's jumbo rate cut. And that includes the surprisingly strong jobs report, then a hotter than expected inflation report, and then yesterday's retail sales report. And for reference, we are talking on Friday, October 18th. But the markets are still expecting the Fed to cut interest rates by 125 basis points between now and mid-2025. So I wanted to start with your outlook for rate cuts this year and in 2025. How many rate cuts do you expect?
Great. Thanks, Neena. And actually, it's interesting, earlier this year, I will answer your question, but I will say earlier this year, you and I spoke on this podcast, and we had just come off a series of really hot inflation prints. And it was funny because at the time we were thinking about we'd started the year with market expectations of like 6 rate cuts. And then after that particular day that we spoke, the number of rate cuts expected quickly was dialed back down to was something like 2. And then, of course, since then, after a series of those 0.4 type monthly readings, we then had a bit of a moderation. You had this 0.2, 0.1. In terms of month-on-month core, inflation increases. And then we had a couple of hot prints recently. But what happened between when you and I last spoke and now is that the Fed was actually able to do a rate cut. It was a surprise 50 basis point rate cut in some ways. Well, surprise, it's a mixed bag, depending who you ask about the surprise. But it was a bigger than expected rate cut. And then since then, we've had this heating up a little bit of the data. So it's funny. There's a bit of a parallel to like when we last spoke to now. What we think in terms of the rate cut outlook, and then by the way, this is not me taking a victory lap, but I will say at the start of the year when we did speak, we talked about the cuts actually happening in the second half of the year, and we say that there would be cuts. We were saying 2 or 3. We do think that the next 2 meetings, based on what we know now in terms of data, we think there'll be a 25 and a 25. But it is a very interesting environment where, as you saw, that really strong jobs number, changed the paradigm a little bit, right? And so, and then the hot readings kind of continued, as you said, with CPI. There's still been that theme that we talked about earlier this year about the stickiness and shelter inflation that's still kind of there. And what we have is a overall economic picture that's stronger than a lot of people have imagined, right? And so, we were talking last time about this soft landing narrative, and that kind of view persists. So, look, market pricing is for about 150 basis points of cuts by the end of next year, leading, and this was just me looking at my Bloomberg screen earlier on, with an implied rate of 3.3%. We try not to get too prescriptive about where we're going to be by the end of next year. I think the market pricing is sitting on top of where the Fed's dots are, but the overall picture that we see is an economy that is relatively strong and resilient, a jobs market that earlier this year was moderating a little bit and then has seen a bit more strength, and inflation that is, it's getting towards where the Fed needs it to be, but then we have a few occasional bumps here and there, right? So you've got core inflation sitting at 3.3% on a year-on-year basis. You've got headlines sitting at a 2.4% on a year-on-year basis. It's not too far from where the Fed needs to be, but I think that'll be the key picture kind of to watch is both inflation and jobs, and what we've seen is the jobs market has become the kind of the key area of focus. So that's, I mean, hopefully that's a bit of a picture. We for the immediate kind of future, we do see 2 more cuts, 25 basis points at each meeting, but we're wary and mindful of the data heading into these meetings. And then of course you've got all the this is the other element of uncertainty is of course the event risk associated with the election and what that means for future policy and long-term prospects for the yield curve. But let me pause there because there's a lot that I just threw at you.
Yeah, so we know that the Fed is data dependent, but one thing we know for sure is that we will get several rate cuts between now and the end of next year. How many rate cuts we get, that may vary according to economic data and other points that you mentioned. So we keep hearing about the cash on the sidelines, and that is going to get deployed into stocks and bonds once the Fed starts cutting rates, because that juicy 5% yield is going away. But there's still about 6.5 trillion sitting in money market funds. That long-awaited, long-anticipated exodus from money market funds hasn't happened yet. It's not really happening so far. So what do you tell your investors, your clients, why this is the right time for investors to step out of cash?
Yeah, it's interesting. When we last spoke, the money market fund balances were at similar levels, and it's actually, I think we're slightly higher than we were when you and I last spoke. So it's a funny kind of dynamic because we've been doing our best to tell clients about the fact that when the Fed cuts, short-term rates do move lower, and they can move lower pretty quickly. But there is this theme, and I speak to financial advisors all across the country, and there is this big theme of inertia. There's a lot of that money that is still sitting in cash. Now, it's interesting. I was just looking at the 3-month rate, right? When we last spoke, earlier this year, it was about 5.4%. It's now dropped to 4.6%. So the short end does come down, and it comes down quickly. But I think there's a little bit of uncertainty for investors around. Okay, when do we start stepping out of cash? And there is a little bit of that muscle memory. If they were earning a healthy yield at the short end of the curve and keeping their risk low, they weren't really thinking about what happens next. But as you might remember, the big themes, the big risks that we call out is one is reinvestment risk, which I've been alluding to, the idea that you're now reinvesting at lower yields. But the other big one is this idea that you might be missing out on price appreciation from having a bit of duration in your portfolio, duration being interest rate risk, that compensation that you get for taking on a little bit more of a longer maturity in your bonds. And so what we've been talking to clients about is, your bonds are acting like bonds again. Stock bond correlation is finally negative again. So that's been helpful. But more than anything, just looking at the yield levels, you've now got a healthy yield cushion. I was looking at the 5-year yield, the US Treasury 5-year yield. Right now it's sitting at 3.88%. It's come down about 50 bips since we spoke earlier this year, but you've still at that level of yield. You've got a yield cushion that can withstand a bit of price loss if for some reason rates go higher or inflation is stickier than expected. But you also do have, because you have it's not 5 years of duration, but you got a little bit less than 5 years of duration of interest rate risk. You've got that potential for a bit of a kicker in performance that can occur when your bonds rally, especially as a shock absorber in your portfolio. That's the reason that we hold bonds in a portfolio is when your risk assets sell off, having a bit of that shock absorber. And right now that shock absorber is looking a little bit more healthy than it did a few years ago in a zero interest rate environment. You've now got some, I don't know, I'm not a mechanical engineer, but the springs of the shock absorber are a little bit more bouncy than they were before. Mm-hmm. We can leave it on that analogy.
Right. So as I had mentioned earlier, bonds are really popular this year. In fact, US listed fixed income ETFs have already taken in over $220 billion year to date. So you mentioned that bonds are acting like bonds again. So in fact, we have seen that bonds are providing the diversification benefits, which they were not providing in the past few years. So is this popularity because of bonds regaining this traditional hedging property, or because of the start of the easing cycle, or there are other reasons also behind this increasing adoption of fixed income ETFs in investors' portfolios?
Yeah, there's a few layers to that, Nina. It's funny. So there's the fixed income decision, and then there's the ETF decision, and I think both of them are interesting ones. So firstly, I mean, I'll say that the asset allocation decision in terms of fixed income, and this is a theme that we've been talking about for basically a little while after the 2022 sell-off that you saw in bonds because of the Fed's hiking cycle, the fastest hiking cycle since the 80s, and the Fed ratcheting up rates really quickly to 5.5%. That was obviously painful for many investors out there. I'm sure some of your listeners probably felt that pain in 2022. Your stocks are down 18%, and your bonds, if you're measuring by the ag, were down 13%. That's not something we're used to, and it's because of inflation, of course. It was super hot at that time, and the Fed needed to jam both feet on the brake pedal. The byproduct of all that is that the opportunity set in fixed income just completely got reopened, right? That was the silver lining that came out of that episode. And so I think the broad, you're like the first answer to your question, Nina, is from an asset allocation perspective, the opportunity set in fixed income right now is fantastic. It's a golden age of investing in fixed income, because you can, for me, the simplest way I'd put it is you can build a well-diversified fixed income portfolio and comfortably get yourself a 5 or 6% yield without really taking on too much risk. Your risk-free rate is doing so much of the work for you, and then a bit of extra spread using credit exposures or using a well-diversified active ETF. These are things that can really help you build that yield. And so that's what we've seen. It's just the opportunity set has been completely refreshed, renewed, and clients are putting that money to work, and they're not needing to really reach out into risky assets necessarily to do so. So that's the first story I'd say, in fixed income. And yes, like one layer to that is, of course, what you said about diversification, which we talked about. That's, of course, bonds behaving like they should. But it's just, for a lot of investors out there, income is the name of the game. You've got, this is a developed country with an aging population, and there are investors out there who need to earn an income off a base of retirement assets. Income is really in focus. That's obviously a fixed income person talking. I'm sure there are plenty of investors out there who are also wondering about, what about this AI trend, and is my Nvidia stock going to go up? Thankfully, I don't need to answer those questions, so I won't. But I'll say, the income. The income question is a very important one, very pertinent one for a lot of investors here. So that's part one. Part two is then the vehicle that you use to make the investment. And again, in terms of an opportunity set, now with the really dramatic adoption, the exponential growth of fixed income ETFs, it's just completely democratized access to the bond market. Previously, not everyone could access the bond market that easily. and you needed a lot of help to do it, or you needed you needed to have a certain amount of assets to be able to do it. Now all you need is a brokerage account, and you could start with a few $100 and you can start buying bonds, right, using an ETF. And that's a pretty appealing proposition for a lot of investors out there who are trying to build a well-diversified portfolio. And so, the access, and of course, we've been, you quoted that $220 billion, number into the fixed income ETF industry. The crazy thing, and I think I might have mentioned this last time when we spoke, but that's been a trend for the past 5 years, even with all the carnage in bond markets we've seen. Or the past, I think, 4 calendar years, you've seen $200 billion into fixed income ETFs across the industry. We're lucky at iShares to be the biggest provider, but that's across the landscape. We've seen these flows, and actually, if we could look under look under the hood of those flows, one of the really interesting things, Nina, it maybe kind of confirms the theory that I was sharing with you, which is you don't really need to take a lot of risk to make money in fixed income. Like if I look at the industry-wide flows, it's over 221 billion. Of those 221 billion, $75 billion went into broad multi-sector ag-like exposures. Like AGG is a fantastic example. It's the industry's biggest fixed income ETF. That is, for 3 basis points per annum, you get exposure to the leading, benchmark of US dollar denominated fixed income bonds, fixed income securities. So that was the biggest category, and that's a very high quality investment grade only benchmark. The next biggest category of flows was 48 billion into government, treasury exposures. Right, so a big chunk of that 221 billion is going into up in quality exposures. You don't need to get too fancy or creative with it to hit your yield targets. And then the next category after that, with 33 billion, was IG credit, investment grade credit bonds. So again, very much an up in quality bias in the flows, and kind of underscoring the point that it's nice and easy to make a healthy amount of income, and you've just got this amazingly broad, and pretty simple toolkit to put money to work using ETFs. And we can talk a bit more about some of the more involved ETFs and more funky stuff, but just the headline story is that you can do a lot of things with ETFs. You have those broad exposures like AGG, but you can also get really specific using maturity cuts. You can, say, I want short-dated credit. IGSB, I think, is a fund we've talked about before, short-dated IG bonds, with a 2.5-year duration for that fund. So, Nina, the key really, and I've been going on for a little while, but when it comes to fixed income ETFs, you really can do a lot of different things using these vehicles for accessing the bond market. So you could get really specific and say, I only want short-dated investment grade credit bonds. IGSB is a fund that we've talked about before, using short-dated, IG bonds between 1 to 5 year maturities. That's got an average duration of about 2.5 years and a healthy yield, kind of close to 5%. You've got, it might be a bit shy of 5% now, but you've also got longer dated treasuries. You can use something like TLT if you wanted to target 20 plus year treasuries, which has got about a 16, 17 year duration. There's really so many different things you can do and construct outcomes using your fixed income ETFs that the world is at your feet as an investor. So it's a good time to be able to access those markets.
Right. All great points. And I agree, flows into fixed income ETFs have been really very impressive over the past few years. And this year, we are likely to see a new record. So let's talk about the opportunities in the fixed income space in the current rate environment. Which bonds or other bond ETFs should I look at?
Thanks, Nina. I appreciate the question because we touched on it a little bit, but we didn't go into depth. On my or our preferred views on positioning in fixed income. The first thing I'd say is in terms of treasuries and in terms of duration positioning, we really do like the belly of the curve. And we've been talking about this for some time now. Some might argue we might have been a little bit early to the trade, but it's been a pretty consistent view that we like that 3 to 7 year part of the curve. Now, that's pretty broadly defined. 5 years is kind of the sweet spot that we were talking about earlier on. The way to play that using a really very liquid, very efficient iShares ETF is IEI, which is the 3 to 7 year Treasury bond ETF. So that's been one favored expression. Now, it's important to note that we prefer using that as a way of adding duration in a portfolio rather than going 10 years and out. We're a little bit wary of the 10-year and out part of the curve due to basically concerns around the government's borrowing needs and fiscal deficits. We just think that there's greater volatility and you don't necessarily get the extra yield that you're looking for at the long end of the curve. So preferred way of adding duration is the belly of the curve. But then one of the other things we've talked about is this opportunity set in fixed income. So, let me expand on that a little bit more. High yield is an area that is much higher quality than it has ever been before. And yes, high yield spreads are, they're inside of 5-year tights. They're actually at 285 basis points right now. That's quite tight. Maybe not as tight as IG spreads, which have just crossed, when they crossed 79 basis points, that's the tightest they've been in many, many years. So IG valuations are also very, very tight. I think the broad story in credit markets is strong fundamentals. Like we said, the economy is strong, but tight valuations. In that context, within high yield, we actually like to get a little bit more systematic. This is a space where it makes sense to try and avoid the losers. That's where you win, is avoiding the losers rather than picking the winners. And being systematic, we use a ticker HYDB. As a way of screening out the riskier issuers and then tilting towards the undervalued issuers. That's been a pretty popular way to do it. And the fund has really grown in the past kind of year or so, especially. And it's been a really neat solution for that challenge in the high yield markets. The other thing that I'd say is, going further out the risk spectrum, there is a preferred view from our investment strategy team for emerging market debt. We do think that there's some opportunities in EM debt with deceleration in inflation in some of those economies, improvements in the global rate environment in the second half of 2024, in this year. And we prefer hard currency debt over local currency because we think that the US dollar is going to remain pretty strong and pretty range bound from here. Now, one of the things I encounter, and we might have touched on this a little bit last time, is there are some clients out there who they don't actually want to take a view on EM debt, right? And so the other way that we've been talking to clients about trying to capture those opportunities in the spread sectors of the fixed income market and capture that extra yield is using an active ETF, something like BINC, right? So the iShares Flexible Income Active ETF. That's been a pretty neat way of accessing that extra yield in the credit markets, getting yourself a yield above well above 6%. But with a risk-managed approach that's run by Rick Reeder and his award-winning kind of investment management team. So that's been a pretty neat way to do it as well.
Yeah, BINC has been very popular with investors. So maybe the performance explains that. And in general, actively managed fixed income ETFs have been gathering a lot of flows. That's an interesting trend. Another area which has been surprisingly quite popular with investors this year is CLOs, or collateralized loan obligations. And in fact, there was an article in the Wall Street Journal recently. CLOs are so hot right now, they're getting ETF'd. And that article pointed out that core issuers, including BlackRock, have recently filed for high yield CLO ETFs. And I know that you can't talk about the filing, but iShares does offer an actively managed AAA rated CLO ETF. So maybe we can talk a little bit about that. But before that, let's take a step back and maybe start with the basics, because some of our listeners may not be familiar with CLOs. So what are CLOs and what's behind their popularity this year?
Thanks, Nina. Yeah, I appreciate the question. I appreciate you politely making sure that I don't have to talk about something that I might not be able to talk about, which is good. But no, I think this is a really relevant, hot topic for sure. CLOs, as a bit of a refresher, it's basically just a pool of higher yielding and lower rated loans where the priority of the cash flows received from those loans and therefore the risk associated with them, it's allocated across different risk and return profiles for investors. That's a process known as tranching. And so the most risk averse investors, right, will invest in the highest quality, highest rated tranche. And they're the ones in the priority of cash flows will receive their cash first. And then they're the last to suffer any losses, right? And so through this process of tranching, you basically create these different pools of loans from which you're sourcing your income. Now, the key characteristics for investors to think about with these CLOs, this process is called securitization. But the key thing is these are basically and also there's a very important distinction that they're not CDOs, which were the things that were the securitized structures that were problematic, to say the least, during the GFC. So these are CLOs, they're pools of loans. And the key characteristic to remember is that they have floating rates, right? So what that means is they have very little interest rate risk if you're a holder of those securities, right? So CLOA, which is our AAA rated CLOA ETF, for example, it has an 0.1 year duration, right? So it's a floating rate exposure. And then because these are still lower rated loans, you have a yield that's kind of in the realm of high yield type levels, right? So right now, CLOA is yielding a 6.12% yield. So typically higher yielding, typically lower rated, and with floating rate exposure. Now, the CLO market has actually matured. It's now a $1.2 trillion market globally, which is roughly the same size as the US high yield market. So it's a much more mature market. And one of the things, we can talk about, when the time comes, we can talk about riskier parts of the CLO market. But the good news with this one that we're talking about is that no AAA rated CLO has historically defaulted, which gives a measure of comfort to some of those clients who are looking at this space and thinking, okay, maybe I want to wade into this area. There might be some attractive yield and low interest rate kind of features to these things, but what is the risk associated with default with these loans? So that's a pretty interesting dynamic that could give you something different to work with in your portfolio. Again, that in fixed income opportunity set is a rich and abundant one these days, and I think CLOs are increasingly a feature of it. I mentioned BINC earlier on. CLOs are Rick Reeder and team are they're investing in CLOs as well in that portfolio. But if you wanted to do a standalone holding, CLOA, it's now it's over $500 million. So it's a pretty solid and investable kind of fund that's been capturing a bit of that buzz, if you will.
So you mentioned that these are floating rate instruments. Do you think they'll lose some of their shine as rates go down?
Yeah, this is a great question, Nina. A lot of our floating rate exposures gathered a lot of assets over the past couple of years as the Fed was hiking, and then as rates stayed elevated. We have a bank loan ETF, BRLN. That's also been something that's seen interest. We have a Treasury floater ETF, TFLO, that exploded with the hiking cycle. And one of the things clients would ask me is, okay, if you think rates are coming down, does that mean I lose money on these exposures? And it's not necessarily the case. It's basically what you're saying is you're just going to be accruing interest at a lower clip than you did before. There's still, in some cases, TFLO is a very high quality exposure, but even with CLOA, you've got a high quality exposure. I think maybe your expression is probably right. They might lose a little bit of shine because of that floating rate characteristic. But going back to what we said right at the start, there's been this inertia, and clients have been wanting to kind of stay short duration. Some clients are a bit wary of duration. So I think there'll still be a pretty consistent bid. And something like CLOA, for example, with that 6% yield and then not having duration means that if you're trying to capture some spread and have a bit of a diversified way of getting income into a portfolio without taking on the interest rate risk, I think it's a neat way to do it. Like I said, it will accrue at a lower rate, whereas at short-term rates, do come down. But it's not that, just because short-term rates come down, you don't get that extra yield in that portfolio. You just get it at a lower level. So yeah, maybe the shine will come off, but we still see pretty consistent interest in these products because I think there's a lot of different ways that clients are going about solving this portfolio problem of generating income.
So let's talk about risks as well. And you had mentioned political uncertainty or political risk earlier. You had alluded to that. And we know that the presidential race remains very tight, and we don't know who will be the next president. But one thing we know is that neither of these two candidates is interested in reducing fiscal deficit. So should bond investors worry about rising US debt and deficit? What are the other biggest market risks that bond investors should be aware of?
That risk is definitely the number one risk that we are concerned about as bond investors. Even Larry Fink has been calling it out in some of his recent media engagements. I've seen him mention it. But across the market, there is a real concern, and it started, I want to say, around August of last year, when you started to see some CBO projections around the government's borrowing needs. Those deficits, the increased borrowing, has created a bit of concern for investors, especially, and that for us, how that manifests is in the long end of the curve. That's why I made that comment earlier on that 10 years and out, we are not so confident of using that as a way of adding duration into a portfolio. Indeed, when the Fed cut, it was not a clear-cut case that long-dated bonds rallied. I think because there is just this concern around the sustainability of the Fed's, of the U.S. government's ability to borrow. What you'll experience it as is greater price volatility in the long end of the curve. The U.S. government is able to borrow. The U.S. dollar is still the world's reserve currency. Some of that is maybe the crypto crowd will attack it, but for the time being, the U.S. dollar is still the world's reserve currency. But I think there is a concern around the U.S. government's ability to keep borrowing money. So that is a concern, and I think that's why we're enacting portfolio decisions using the belly of the curve more so than the long end. That would be the main concern, main risk. The other one, we think that inflation, it may settle at a higher level than previous years, right? So that could be a different paradigm for investors to kind of think about when it comes to inflation. Whether it's inflation-linked bonds, which have been out of favor in the past year and a half, but is that a way of managing inflation in a portfolio, or are there kind of other explicit yield targets you have to set to try and beat inflation? Inflation is still a persistent risk, and we just saw that with the data prints in the past couple of weeks. So that'd be the other big risk kind of I'd call out, is that what happens if you see this reacceleration in inflation? So fiscal deficits, inflation, and then the last one, I guess, we are we're all in markets. I think the prevailing narrative is a pretty sanguine one about the macro picture, but you did see. When you had this a couple of months ago, when you had a weaker than expected jobs reading, payrolls reading, suddenly this narrative shifted. I think August was a pretty volatile episode this year, and you saw this narrative shift towards, what if this soft landing is not so possible? Maybe we head to recession. I think markets overshot, as they tend to do, but that would be another risk on a macro picture level. What happens if this tremendous economic momentum that we've had over the past couple of years, what if that comes to a more rapid stop or rapid halt? I don't want to say halt, but like to a more rapid deceleration than investors are expecting. So that's a concern. I think you're right in the way you characterized the election. both sides are looking to, whether it's taxing less or spending more. They're not really looking at austerity anytime soon, and so I think the risk around deficits and borrowing is still front and center. So we'll see how it all kind of plays out.
We'll see. Excellent stuff, Dhruv. We'll have to leave it there. But thank you so much for joining us today and for sharing your insights.
Thank you so much, Nina. Really great to be with you.
That was Dhruv Nagrath of BlackRock. Now let's recap the ETF tickers that we discussed. So he talked about investing in the intermediate part of the yield curve, and the ETF by iShares is IEI, the iShares 3 to 7 year Treasury bond ETF. Another ETF that I like for exposure to that area is by Vanguard. Vanguard Intermediate Term Treasury Index ETF. The ticker symbol is VGIT. Now, for high yield bonds, he talked about HYDB. It is the iShares High Yield Systematic Bond ETF. It focuses on issuers with healthy balance sheets and attractive valuations. So a safer way of getting exposure to the high yield space. And he talked about the actively managed flexible income ETF, which has been very popular with investors this year. The ticker symbol is BINC. Now, we also discussed CLO ETFs, and the iShares product for investing in AAA rated CLOs is CLOA. And the most popular product in that space is by Janus Henderson, that also focuses on AAA rated CLOs. And the ticker symbol is JAAA. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episodes. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.